In this week's update, US tech mixed but overall positive. Will the market change its focus? And a good week for commodities. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Let's start with our market perspective. Are the US valuations stretched or not? We constantly have a deluge of opinion on this, most of it negative, telling us that the Cape-Shiller ratio is ridiculously stretched or whatever number it is. But it all depends on how you look at the data and the way you analyse it. So it's an interesting question, but if you're looking at the index alone, then it really doesn't matter. You need to be looking at individual stocks or individual sectors or slivers of the market. And the fact is that growth, earnings growth and revenue growth in big tech remains strong in America. And certainly the results that we got through the week for big tech were still showing very good growth. But the character of that growth has certainly shifted over the long term. And this growth is real. It's sustainable, unlike what we saw in 1999 leading into the massacre in technology and the NASDAQ. This is very real, it's very sustainable, and it's going to continue for a very long period of time. How the market awards valuations from time to time will change. Sometimes the market will get way ahead of itself and these stocks will become far too expensive. Other times it'll get fearful and these stocks will be highly attractive. So it's a matter of understanding very clearly what your targets are and what your entry prices look like. So what appeals in the Magnificent Seven and other technology? Well, this isn't the forum for me to go into that in detail. That's obviously reserved for members. But I'm going to show you the results for Meta and Google just to register a point about the growth in tech earnings and therefore how that relates to the valuation of that sector, because a lot of people are saying that the US market is very much at risk because valuations are stretched. And I think these numbers will probably explode that myth for you. Now, the US economic data, is it good news or bad news? The GDP has slowed from 3.4% to 1.6% quarter on quarter. So that's not good. But of course, it's always, how does the market perceive that? Because the market might perceive that as taking pressure off inflation, and it may influence the Fed to cut rates earlier. Is it saying that the high rates that we've had over the last 18 months, have they done their work and they're having an impact? And they're slowing growth. It's only one data point, time will tell. But the PCE indicator, which is one of the Fed's preferred measures of inflation, so personal consumption expenditure, has stopped falling. It's steady month on month. And so inflation is not continuing to decelerate. So hopefully we're not heading for a situation where growth is slowing, but inflation starts to tick up again, and the horrible word there is stagflation. So hopefully we're not heading towards that sort of scenario. But certainly in big tech, that is very much not the case. There are some positive factors. Money supply is increasing, and there is a historically, over the long term, I'm talking over decades here, historically, there's a very high correlation between money supply and the direction of the market. And when the market declined significantly in 2022, money supply was decreasing, and that certainly contributed to that. Now, at the moment, money supply is increasing, and that is helping to support the advance of the market that we're seeing in general terms. So the market has been totally besotted with this issue of how many rate cuts in 2024 and when will they start. And the hopes of that happening are fading rapidly given the changing economic data. So could this money supply situation be the factor or one of the factors that refocuses the market away from the rate cut story? Could it be that big tech earnings also refocuses the market away from its just total preoccupation with how many rate cuts and when? Because that's not really a a particularly healthy situation for the market to be relying on rate cuts to go up. So as I said, the rate cuts hopes, they're fading pretty fast. If we look at the negatives, you can always build a huge shopping list. We've got obscene levels of debt, but that's been the case for 3 or 4 decades. We've got geopolitical risks, probably as many as we've ever seen. Protectionism is making a huge comeback. We've got seemingly ingrained inflation in some countries, et cetera, et cetera. There's always a very, very big list that you can write out that will worry the pants off you. But at the end of the day, and that's what I try to do primarily in this Sunday video, is to provide you a perspective on where the money flows are going. What is the market actually doing, not the logic of what it should do, because a lot of the time those two things are quite different. So before we jump into US stocks, let's just take a quick look at the results of Google and Meta. So the way the market treated these two results through the week was absolutely chalk and cheese. So the opposing fortunes of at least a couple of members of the Magnificent Seven. So if we look at Google, Q1 earnings came in at $1.89 and they beat by 38 cents. Now, for a company the size of Google, $2 trillion, to beat by that much when you've got 40, 50, 60 analysts all over you every day of the week is a pretty amazing effort. So that was a huge beat. It just continues the practice of beating consensus. Revenues also came in at $80 billion, which was a 15% rise year on year. Again, that is huge revenue rise for a company the size of Google. And that beat by nearly $2 billion. The margin, this is the one for me that I really take a lot from. The margin rose from 25% to 32% year on year. Again, that is a massive increase in margin. And that is, to me, the most important figure, or more important than revenue, because you can raise revenue by discounting or whatever other means you want. But if you are growing your margin, you're growing your revenue 15%, you're growing your margin as well, then that's a really good sign for the future. Plus, they included a buyback up to $70 billion and a dividend of 20 cents a share. Okay, the dividend, 20 cents, it's nothing, it's neither here nor there, but it's symbolic. First dividend ever. Now, if we look at the earnings and the earnings per share growth, so we come back to the question of, is US tech overvalued? And when you look at these numbers, so for FY24, the forecast is 750. One would think that the actual will be better than that because that's just what they keep doing. And that's showing 29% growth in earnings year on year and a PE of 23. So that's absolutely fine in the year we're in. We're almost halfway through it. If we look at FY25, a further 11% growth, FY26, 15% growth, and then FY27, 20% growth. And you've got to remember now, okay, it's going out 3 or 4 years and there's a lot of assumptions being made in there, but you've got to remember this is a company with a terrific history of beating consensus forecasts. And look at what the PEs are heading towards, 20 and less, between 20 and 15. You can't look at that growth and look at those PE ratios and say that Google is overvalued. So, that explodes that right there. And look at the way the market rewarded the company with a massive increase in price on Friday. Now, on the other side, let's look at Meta. Meta had earnings of $4.71. That beat by 35 cents, which was a very comfortable beat. And revenue also beat by just a little bit, $36.5 billion as against $36.2. But it wasn't those particular numbers that disturbed the market. It was that their outlook for growth was probably not quite as strong as the market was expecting. And so Meta got smashed down 15%. Massively different market reactions. But again, if we come back to valuations, look at the growth year on year that's being forecast. And most of the time, Meta will be meeting or beating these forecasts. So 34% and then sort of mid-teens growth year on year, and you're only paying mid-teens PE, mid to high teens PE. This is not expensive. So I don't understand the argument that big tech is overvalued in America. Now, the relevance of that, for those of you out there that only invest or trade in Australia, you might think, well, I don't care what Google and Meta are doing. The important aspect here is if these companies are not overvalued and they're still growing strongly, then that will support the indices, the American indices. That creates a positive sentiment, and that positive sentiment flows through to the rest of the world. So that is the relevance of why I went through that exercise, because it's just so important for markets everywhere else. Okay, let's have a look at US stocks. 2.7% was the rise across the week. As I said, mixed messages. One, very, very positive results. The other one, good results, but outlook a bit less than what the market expected. But we've also seen a lot of variability in the earnings outcomes. Some stocks and sectors are doing well, others aren't. And so it just underscores again how critical stock selection is. And if you're using the index as your guide to how you invest, then I would suggest very strongly that, it's just not an accurate or productive way to do it. You've really got to get down to the individual stock level, because just look at the difference in how Google and Meta were treated by the market. The US dollar index was pretty much steady. 10-year yield continues to rise, 4.7 almost. And the VIX eased down to 15. So let's jump back to the charts and take a look at the S&P first of all. So there's the S&P on a weekly chart. And this is what I said last week. The challenge is to own what is still going to rise, and still have the process to take advantage of that. So quite a decent rise in the end across the week, but it was pretty choppy and volatile. If you look at the way the week unfolded, there were gaps all over the place, up and down, and this big gap down partly because of the reaction to Meta, and this big gap up partly because of the reaction to Google. So all over the place for the S&P, but net was quite positive. Now, importantly, let's go and have a look at SMH. So last week, when SMH had been going down quite strongly, which I made the point that was only that was only part of a shorter term correction. Didn't know where the bottom was, but it was something that was pretty healthy for the market. So I posed the question whether, all of a sudden you'd be forgiven for thinking the way the market was reacting that semiconductors had suddenly fallen way out of favor, and artificial intelligence wasn't going to have the impact that people thought it was going to have. All those sorts of wild thoughts, because this was very concerted selling. But for the organised investor, it was an opportunity. It was an opportunity to buy into things that had been trading at perhaps technically stretched levels. So what you must know in advance is you understand what your targets are. I've had targets in Australia that I've waited on for in excess of 12 months, sometimes 18 months. And an event eventually comes along that creates a bit of irrational selling and creates a good opportunity. So you got to know what your targets are. You got to know what your entry signal looks like. And I'll show you one of those in just a minute. How you intend to manage the investment. So how are you going to enter? How are you going to take profit? How are you going to protect profit? And of course, your time frame and purpose, short-term, long-term, Are you buying it for the growth, for the dividend, whatever it might be? So you've just got to be clear in advance about how you're going to use that asset to create wealth. Let's look at the semiconductor versus the S&P. We had a big dip, but also a big recovery. Life has seemingly returned to normal very, very quickly. If we look at the money flows on a sector basis, so I've gone back 12 months now. So over the last 12 months, clearly the more aggressive sectors, technology, communication services, and then finance and consumer discretionary were leading the way. We had consumer staples at the bottom, but of course you can notice that just in the last couple of weeks, consumer staples has ticked up, whereas the more aggressive sectors initially ticked down, but then did pick up towards the end of the week. So if we look over the last quarter, we get a quite different picture. So this is the rotation in practice, led by energy right at the top, materials also picking up, and then we've got finance, and the more aggressive sectors of technology had fallen out of favour, particularly over the last 2 weeks. So you can see just how sharply technology and communication services had fallen, but equally in the last few days, how much they've rebounded. So there's the sector flows. We had a short-term rotation. Whether it's complete or not doesn't really matter. Just, as I said before, focus on your targets, be clear on what your entry looks like, and move forward from there. This is the Australian market over the last year. Information technology clearly still leading the way and has done so for most of the time. We did get a period through here where it underperformed relative to other sectors, but most of the time, this sector, which is led by stocks like Xero and WiseTech Global, has been the leader. Finance has been pretty solid throughout. Small caps in the middle of the pack, and surprisingly, banking and healthcare more towards the bottom over the last 12 months. If we zero in and just look at the last couple of weeks to see who's doing what, the order hasn't really changed much other than healthcare has certainly picked up off the bottom, and energy has gone from somewhere higher down to really at the bottom of the pack at the moment. All right, now I did mention in Australia there was a stock that the market responded extremely well to, but also coming back to the opportunity. You've got to know your target. I might actually spell that properly. You've got to be very clear about what your target is. Now, ResMed. This is a weekly chart. ResMed was a stock that I've been wanting to get into for, probably more than 2 years, but actively looking for an opportunity to get into the stock for between 12 and 18 months. And when it was trading up here, it was either fundamentally overvalued relative to the business, how I saw the valuation, or it was just technically overvalued as it was up here. But I knew what the entry I wanted looked like, and when we got a bit of an irrational shakeout because of fear over weight loss drugs, it provided that opportunity. So I grabbed it with both hands, and that was one of the strong recommendations in the Insiders Club, to buy the stock down here in this basing pattern, and it rebounded pretty predictably and very nicely over a period of time, because that was late last year. But it's all culminated, if we look at what happened on Friday, the ResMed results came out, impressed the market, and we got a very significant jump in price. And you can see over the last 4 or 5 days, the volumes have been very good, closed up near its highs. I make no recommendation about what anyone should do with this if they don't currently own it. That's not the point. The point I'm making is knowing what your target is, being clear about what the entry price looks like. What does the opportunity have to present itself as for you to pull the trigger? And then, the negativity around ResMed at this point was quite extreme. And that in itself tells you something. When everybody's totally negative about a quality stock, it's time to get very, very interested. Okay, moving on now to the Australian market. The Aussie dollar, 64.74. Our market fractionally higher, but Friday was a shocker. It was one of the worst days of the year for basically every sector. But despite that, we saw some stunning gains, and ResMed was one of them, but there were certainly plenty of others in the Insiders Club portfolios. So it just underlines that this is very much a stock picker's market. This is not a market that you want to be approaching from a general index point of view. Just understand what your really, really good targets are, and be patient and wait for them. So if you're watching the index, if you watch the nightly news to see what the index is doing, complete waste of time. And even worse, if you own the index, then you could just do so much better by being more focused on individual stocks. Now, last week, gold and copper did quite well in Australia, and the activity of BHP with their attempted takeover for Anglo American certainly highlights how BHP sees the copper market going forward. All right, let's just have a quick. I'll just do the currencies first of all. This is DXY. So not a lot of change across the week, but the Australian dollar was actually stronger. I guess that reflects the fact that commodity prices have remained strong or have improved. If we look at the ASX 200, the long-term return. So this is a weekly chart, so you can see we were pretty much in line with the previous week. But if we look at Friday was quite nasty. Now, one would think the way the US market finished that might put a bit of stability into the Australian market, but that was a pretty nasty day on Friday. The long-term return in the Australian market is, depending on which way you analyse it, is something like 7.5-8% per annum long term. A lot of money which is in self-managed super funds or managed funds is effectively invested in the index because it's invested across a very diverse basket of stocks. And I just want to make the point that there are just so many viable, productive alternatives for your money, and I'll have more to say on that in coming weeks. While I'm here, let's look at the gold and silver chart. We'll start with silver first of all. So silver, bit of a roller coaster on Friday, but net it was it certainly finished the week positively. We had a very significant move down on Monday, but managed to claw back part of that. If we look at gold in US dollars, we also had plenty of volatility there. This is a weekly chart. We got as high as 24.50 at one stage, closed back down 23.38. So plenty of volatility up here, but the longer term trend is clearly up. This breakout is being sustained. Yes, we had selling up here, but equally we had buying as well with those long wicks, top and bottom. This is the gold price in Australian dollars. So similarly, a bit of a volatile finish to, or not so much a volatile finish to the week. We certainly had a strong move down on Monday, and it stabilised during the week. Now, if we go to the GDXJ to see what's happening on the global gold stock medium, then GDXJ, a little bit of a response, but it's still not really outperforming the gold price. And if you look at the relative comparison, I'll do this one with the Australian dollar versus GDX listed in Australia. You can see that we are getting a little bit of catch up between GDX and the Australian dollar gold price, but it's still nowhere near what you would expect it to be, given that gold stocks should be amplifying the underlying move in gold. So I still think the best is yet to come in the gold market. So just summarising, gold down $55 to 2338. In Australian dollars, 35.84, which of course is extremely profitable territory. And for mine, my focus is very much on the highest quality gold developers with resources, significant resources that have high strategic value. That's where most of my focus is going in the Australian market. Other commodities, copper, 459, nickel, 860, and the BHP move on Anglo American really makes a huge statement about how they see the importance of copper in their future. In fact, you could almost, given their comments and the corporate action, you could almost say that they're expecting copper to take over from iron ore as perhaps one of their leading profit makers in the future. Crude oil, WTI, West Texas Intermediate, was up 83.72. And look, in the shorter term, the oil price is all over the place. We've got geopolitical influences. We've got the US dollar strengthening on the basis of less Fed rate cuts. We've got week by week changes in inventory. So the short term is very, very difficult to anticipate in the crude market, but the long-term supply and demand balance still remains tight, and it's a lot tighter than what had been expected if you go back 3 months or 6 months ago. And I think over the long term, it's going to remain the situation. So I think the long term for the oil price continues to be above where the market is currently trading. Wrapping it all up, I'd encourage everyone to see these sharp corrections that we get from time to time as really good news. See them for what they are. They're just relieving short-term excesses. Very, very few of them are significant tops in the market. Mostly they're just setting up opportunities, because in a bull market, 2 steps forward, 3 steps forward, 1 step back is normal. It's healthy. In fact, you actually want to see it. So, don't get anxious about it. Don't wring your hands. See it as an opportunity, because the less informed, the less experienced are happy to sell you their quality stocks at a discount. So say thanks very much and accept it. But to be able to do that, you have to be very highly organized, because in the flurry of the moment when the market is falling, it's actually really difficult to do that, to pull the trigger, because everything is so negative. So embrace them, don't fear them. That's the message. Portfolio analysts last week focused on, particularly with a lot of early stage small cap stocks that have got, particularly with new technologies, that have got seemingly fantastic stories. Most of them don't ever work out within any sort of remotely reasonable time frame. So don't fall for just a good story, because I would hazard a guess at least 80 or 90% of them do not lead to a profitable outcome in a period of several years anyway. They might eventually get there, but that might be 10 years long. We also looked at some great opportunities for buying both in Australia and in America. So that was portfolio last week. All right, that's it for this week. I'll be back with you next Sunday. There is more information on the website. There's my email address, and have a great week. Cheers.